Next up is John Donnelly, an equity analyst covering the technology sector at Jennison. John, thank you for joining us from California and for sharing your expertise with our audience today. Let's dive straight into our first question. AI continues to dominate investor attention. Some commentators have drawn parallels between today's AI excitement and previous periods of market exuberance, such as the dot-com era. Do you believe AI is the next tech bubble, or what makes this cycle different from past technology booms?
While the comparisons to the dot-com bubble are logical, we believe that the AI era is going to evolve very differently, and those comparisons will be misguided. There's a few reasons for that. The first is the total addressable market for AI is going to be far greater than the internet. With the internet, it was a game-changing technology that allowed humans to take action and do work. Whereas in the AI ecosystem, we're harnessing all of collective human intelligence, and agents will be doing work for humans, which produces massive productivity gains. And we're just at the beginning of that cycle. Also, the monetization path of the internet followed a very different evolution. The attitude was build it and they will come. We spent a lot of money on CapEx ahead of demand for internet products and services. For example, in 2000, the top internet companies produced around $10 billion in revenue. Those were AOL, eBay, Amazon, whereas they spent $1 trillion in CapEx to produce that revenue. If we look at the numbers on AI today, AI is also already producing $300 billion in revenue, but we've spent the same $1 trillion in CapEx. So the numbers look completely different. The third important distinction is on the funding of the internet versus AI. The internet build out was funded almost primarily by debt financing, whereas AI has been funded by the cash flows of the greatest companies on earth, which are all AAA rated credits.
Thank you, John. And what are the biggest risks to your AI investment thesis? What indicators would you monitor that would persuade you that this investment case remains intact?
The biggest risk to the AI thesis is that product innovation slows, demand for AI products stalls, and the data center build out comes to a screeching halt. We don't see that any indications of that happening today, as product innovation is just taking off. It's in the very early stages of that. You can see it in the use cases that are evolving. Coding is already a real use case, driving a tremendous amount of energy in the AI ecosystem. We have future use cases that haven't even begun to ramp, such as customer service, commerce, advertising, and breakthroughs in healthcare.
Thanks, John. One of the portfolio managers of the Curate Global Growth Equity Fund, Tom Davis, recently noted that mega IPOs such as OpenAI, Anthropic, and SpaceX could become some of the most significant market events in years, given their rapid index inclusion and the substantial passive inflows that may follow. How does Jennison strategically prepare for these types of events? And maybe you could explain a little bit of your rationale behind including SpaceX into the portfolio.
We're extremely excited about the IPO pipeline with OpenAI, Anthropic, and SpaceX just going public. At Jennison, we feel like we really have a competitive edge from a few angles. We have a 360 view of the entire ecosystem, from the data center build out to the AI applications that are proliferating in the market now. We have deep domain expertise in these areas. Jennison has a long history of investing in the most innovative growth companies. We have the scale, the relationships, the network, and we're truly global, so we can connect the data points around the world. That competitive advantage gives us a deep research edge. For example, when ChatGPT was first released, within weeks of that release, our firm was on the phone with Sam Altman talking through the potential for AI. We meet with Anthropic many, many times leading up to this IPO. We have a deep understanding of the company, what they're trying to accomplish, and what the roadmap actually looks like. Those relationships are invaluable. When we think about the individual IPOs, they're all exciting in their own ways. Anthropic is the fastest growing company in the history of the world. That is not a hyperbole. They have ramped in 3 years from zero to $60 billion in revenue, and we think they're going to be doing over $100 billion in revenue by the end of 26. That is staggering. OpenAI is in a similar camp in that they are doing over $40 billion in revenue. We also think they have the potential in the next 12 months to be over $100 billion in revenue. Those are huge, huge numbers. And it took other technology companies, the largest in the world, decades to produce that type of output. When it comes to Anthropic, they're specifically focused on the enterprise exclusively, which is doing work for companies and allowing companies to accomplish things that they could never do before in a much more efficient and clean way. OpenAI has taken a different approach, which is that they want toeholds in both the consumer market with ChatGPT subscriptions and the enterprise market with coding agents and other AI applications. So the companies are going after similar markets with a different DNA. SpaceX is the most exciting new IPO we've seen in a long time. The reason we decided to participate in the IPO is multiple fold. Number one, our investment process centers on trying to find the most unique companies that are almost impossible to replicate. SpaceX certainly fits this criteria. They are the leader in two of the largest emerging markets we've ever seen, space and AI. In space, they've accomplished engineering feats that are truly incredible, which is they have been able to put rockets into space faster, cheaper, and more reliably than ever in history. Those engineering feats are incredibly difficult. They now own 80% of the share of the space economy. There is no competition that can catch up to them within the next decade. Their lead is almost insurmountable. When it comes to AI, it's self-reinforcing with the space ecosystem. They're a leader in AI data centers. They've built all their own data centers, and they are at the bleeding edge of technology. We believe that that ultimately will translate into their long-term goal, which is to move data centers into space. We think this is a realistic goal based on engineering that they have today, and we think this value creation opportunity will eventually emerge and be reality.
Certainly very interesting and topical. Another question. Many investors think of AI as a narrow investment theme dominated by NVIDIA and the hyperscalers. Where are you currently finding less obvious opportunities across the AI value chain?
NVIDIA is an incredible company, and they kicked off this amazing AI wave. However, it's not the only way to invest in AI today. We believe that the data center build out is multi-year with long duration. There'll be trillions and trillions of dollars spent on these data centers, and they all face unique challenges. Right now, the demand for AI products far outstrips the demand for compute produced by data centers. Inside the data centers, we found many opportunities that are hidden unless you dig deeper. A few of those opportunities are the tools that have to make the chips that go into data center, the liquid cooling that has to be provided, the networking equipment that makes AI possible, and the memory that stores AI. But we think one of the biggest bottlenecks and one of the most important themes is power generation. The electrical grid cannot physically keep up with the demand for AI. To solve that problem, we found a number of companies that are truly revolutionary. One of them is Bloom Energy. Bloom Energy has produced fuel cells that connect directly to an AI data center. They do not need to connect to the electrical grid at all, therefore producing AI power without being constrained by the time it takes to build out the grid. We think that power behind the meter, behind the electrical meter, is one of the bigger themes over the coming years.
That's interesting. Thanks, John. Finally, the last question. If you were speaking directly to long-term investors who are concerned that they may have already missed the AI opportunity, what would your message be?
We are at the very, very beginning of the AI investment opportunity. There are so many new markets that are going to be created by AI. Right now, the reality is there's really only a few use cases that people are engaged in today. Coding is a tremendous one that has taken off, and it is accelerating at a very high rate. However, the biggest markets in the world, such as the consumer, hasn't even been addressed by AI yet. The opportunity in commerce is incredible. Advertising will eventually be taken over by AI and revolutionized. Healthcare is one of the biggest markets in the world. The products that will come out around drug discovery, research, and care will be mind-blowing. We're just at the beginning of the agentic application age. That just started. As of today, we've really only been able to invest in the data center build-out. We're incredibly excited about what the agentic world will offer from an investment perspective.
Thank you once again, John. Truly a fascinating perspective on the evolving growth and technology landscape. What really stood out was how AI continues to drive a new wave of innovation, not just within technology, but across industries more broadly. And the discussion around IPO activity was particularly interesting and certainly very topical. If I now move briefly onto the Curate Global Growth Equity Fund. The strategy invests in companies with the ability to benefit from long-term structural growth trends, like the examples we just discussed. While growth investing has experienced periods of volatility, the opportunity set remains compelling, especially for companies driving innovation, sitting at the center of supply chain bottlenecks, and capturing new market opportunities. This makes the fund particularly well-suited for investors looking to capture global growth opportunities within a diversified portfolio.